Well, good morning and good afternoon. Welcome to the February 11th WASDE review webinar. My name is Greg Horstmeyer. I'm editor-in-chief at DTN, and I'll be your moderator for today's event. With me today, as always, is our lead analyst, Rhett Montgomery, who will go over the WASDE numbers and discuss what they mean to U.S. and world markets. Rhett and I are coming to you today from snowy Louisville, Kentucky. This week, we're here for the National Farm Machinery Show, and we'll have some daily educational outlook sessions with both Rhett and our ag meteorologist, John Baranek, and I'll have some more information on that at the end of the webinar today. So if you're planning a trip to Louisville or thinking about it, hang on here to the end and I'll talk a little bit about what we're going to be doing at the show this week. As far as today's webinar is concerned, as always, we're in a listen-only mode for the audience. But you can ask questions at any time. And in fact, a few of you have already started to kick some questions in. You can do that by clicking on the Q&A panel that's on the bottom right of your screen. And that'll open up a messaging panel and you can type in questions to Rhett and me. We'll address those at the end of the webinar after Rhett finishes up his comments on today's report. And also, as always, this event is being recorded and we'll have a broadcast link that you can refer back to or share with others. And that'll be on our DTN.com website within 2 business days. Again, that's the DTN.com website, which is the same place that you signed up for today's webinar. With that, I think we're ready to begin. So we'll turn things over to Rhett. Rhett, at the end of the WASDE report stories as we were filing today, one of our reporters said, well, that was pretty undramatic. I guess that kind of captures the essence of what happened today. What's your thoughts on everything?
Yes, absolutely. Good morning, good afternoon, everybody. Thank you for joining us to recap, like Greg said, what was a very, for the most part, uneventful February WASDE report from the USDA. As he said, made my job certainly easy this time around. We were joking before we kicked things off. So there were some changes, mainly on the world side, but we'll go through them here in finer detail. But as mentioned, for the most part, a neutral report. I will lead off by saying, as we speak, corn futures right now down 4 cents on March, soybean futures down about 5 cents on March, and Kansas City wheat futures down a touch as well here. So a mixed reaction here. Most markets were firmer going into this report, so maybe some wind taken out of the sails by the almost frustratingly neutrality of the report. So altogether, though, very quiet market response thus far, which would be expected as we'll get through these numbers. So leading off with corn, USDA for the U.S. balance sheet completely left everything unchanged. So just going down the board there, no changes. Obviously, across the supply, they finalized the yield last month. We were saying before we kicked off the webinar that the USDA likely could have found some of these buckets on the demand side to touch up if they'd so pleased in this report. But I think for the most part, they're willing at this rate just to focus on the world numbers, especially with the key weather and everything in South America that we'll get into. But so overall, unchanged on ending stocks, still at 1.54 billion bushels. The one thing they did update, I guess I should mention, is the average farm price estimate, simply as a result of the higher futures price. The price rally really since late fall and into the new year has resulted in higher cash farm price on average through the first few months of the marketing year. Looking at the world side of things, that's where we got our changes this time around. The market had come into this report expecting, for the most part, the cuts to come out of Argentina due to the very hot end of 2024 and beginning first 3 or so weeks of 2025 in Argentina. There was areas where, less than an inch of rain over 30 days and temperatures above 90 to 100 degrees for the most part. So was really expecting the USDA to express some damage done for the earliest pollinating corn in Argentina. They did give us that. but maybe to a lesser degree than some people would have expected, a 1 million metric ton cut to Argentina, as you can see in the leftward red box. The surprise on this one, if there was one, was that they did decide to go ahead and cut Brazilian production by 1 million metric ton as well. Brazil is currently planting their safrinha corn crop in Mato Grosso, the leading corn producing area. That planting progress is off to a very slow start. I believe last week it was around 20 to 25% completed versus an average pace of around 35%. So lagging there. The big story there is if anything late planted into March will be subjected to much more of the dry season come late April, May, and especially with weather patterns this year, maybe calling for that dry season to start a little earlier. Could have some of that corn pollinating through some very hot and potentially dry weather. So that, I think, is what the USDA was looking at there when deciding to be preemptive there and trim that down. It is worth noting that CONAB, the local Brazilian agency, is they're at about 120 million metric tons. So still a little bit of a gap there between the USDA and what the local Brazilian government is estimating. Jumping to ending stocks, the result there was a 3 million metric ton cut to world ending stocks. You will notice I've mentioned China corn production was unchanged, but the big thing in this report is they did reduce estimated Chinese imports by 3 million metric tons. And when all was said and done, that was where our ending stocks number was more or less reduced by. As you can see, not including China, our corn stocks basically unchanged from the January estimate. So if there was a maybe, bearish twist to these numbers and the cuts that we got out of South America, it's that it didn't really have any effect on the ending stocks once you take out China out of the picture there. So China really heading back towards their pre-COVID levels of corn imports. Large importers heading into that, they needed to rebuild stocks, and so obviously they went on a huge buying spree, as we know, for those years. But so on the world, largely as meant neutral, but maybe gets the ball rolling and will raise scrutiny, I think, moving forward on Argentinian and Brazilian weather, especially as mentioned, that planting progress in Brazil, which is entering just a crucial period here over the next few weeks to see if producers there can catch up on pace. Closer look at the world ending stocks. As mentioned, 3.43 billion bushels of global ending stocks. That's not including China. As you can see, unchanged from last month, more or less, and still the least amount of world stocks outside of China since 2012-2013 season. So 12 years going back there. So still a semi-supportive, I would say, world corn stock situation. Diving heavier into the U.S. balance sheet, U.S. corn exports still strong. I thought we'd maybe get some acknowledgement of this in this report. It was very interesting. I think I mentioned last time around in January, the USDA cut export expectations in the January WASDE by 25 million bushels. I certainly didn't agree with that then. I don't agree with it now. But I guess I should have known that they weren't going to, undo that estimate just 1 month removed. But as you can see by the green line on the chart, weekly corn shipments have pretty much trended above 5-year and 10-year averages from the jump this year. As of January 30th, corn export commitments have totaled 1.76 billion bushels. That's between 877 million shipments and 885 million bushels of sales. All totaled, that's running 28% above 2023-2024, with the USDA estimate of 2.45 billion bushels, only a 7% increase year over year. So very strong pace thus far. I mean, obviously there's outside noise, political tensions, what have you, that the USDA may be putting into their estimates. But just given the numbers thus far, a very strong export pace and really going neck for neck with 2020, 2021 thus far. which obviously that year stands tall above the rest as a record year for U.S. corn exports. So very good pace here through the first third plus of the marketing year thus far. Looking at ethanol, kind of the same thing, a reflection of very strong demand for corn. Looking across that graph, the red line is the current marketing year. As you can see, looking back over the past 6 years, it's well at the top. It did, slip slightly into December and likely into January as well, as ethanol margins during those months did have a moment there where some plants went negative, and overall there was a tightening of margin, mainly as a result of the corn price going higher through the late fall and into 2025, but also some spikes in natural gas costs ate into those margins as well. So through the first 4 months of the marketing season, 1.86 billion bushels of corn was ground for ethanol production. That was 1.5% above 2023-2024. The USDA estimate of 5.5 billion bushels is accounting for a 0.5 point increase year over year. So it is worth noting that despite those tight margins, we did have a good weekly ethanol production numbers in January. There's really only 1 week there towards the end of January where we had a sizable, around a 90 or so thousand bushel or barrels per day, cut. Other than that, it stayed relatively flat, slightly off the record numbers we saw last fall, but still overall very strong. So I expect this red line, when it's extended to January here, to show, maybe even a slight uptick, and definitely a keeping with the strong pace we've seen thus far. Tying it all together into the national corn basis, using DTN's National Corn Index implies a basis right now of about 33 cents under the March board. This is the second weakest in the past 10 years. This is where I find this really interesting and really gets the wheels turning of what are we missing here. As mentioned there on the right, the basis currently is the second weakest of the past 10 years, and the basis that is being priced in is pricing in a basis similar to what you would have seen in a crop year around 2017 or so, when we were, 2+ billion bushels of carryout. So obviously we're significantly below that in carryout right now. So my question is instantly, when I see a graph like this, becomes, okay, what are we missing here? Is the demand really not that strong? Well, we know going through the graphs we just went through that our U.S. demand is still very strong. So it makes me wonder, okay, well, did the cut in January production, U.S. corn production, was that accurate? So what's driving this basis down? Where's all this corn coming from that end users are being so able to break the basis back through this futures rally? So jumping to the next slide, I always go to the spreads. Whenever I don't understand the basis, I go to the spreads, because they're really the two sides of the same coin. And when one's, maybe acting strange, usually the other one can give you some explanation. So I think this maybe explains it, at least in my mind. I'll walk you through what I have here on this chart. Basically, the blue line is our corn forward curve as of a month ago, as of January 2nd, 2025. And the orange line is a month later, as of last Friday. That's the forward curve. So as you can see, paying attention to those prices that are labeled on the data points, month over month, the board added a lot of carry into the market. So we were basically working with a dime carry from March to July, and now that's widened out as of last Friday to closer to 17 or so cents. But as you can see, what I pay attention to mainly is, look from May to July, look from May to July, the 467 to 470 a month ago, and now $5 to 504. So they're not building any deferred carry in the market. So eventually what that tells me is, when that front month carry was so tight, when we were only paying 7 to 8 cents for commercials to carry corn past March, it tells me we probably had a lot of commercials dump inventory during December and the first part of this year when basis got so strong towards the end of November, as can be seen on that last slide. I think we saw commercials, really hit the market hard and just start dumping inventory. And now the market's signaling, okay, we need to build some carry, but obviously not a whole lot as we still slip into an inversion by late summer into September. So I think that maybe explains that, interesting basis action we've seen where, we do know from the stocks report too that commercial ownership of corn is slightly higher this year than the year before, about 2% higher. So more commercials own more of the corn in the market, probably have a little more power over driving that basis one or the other when they decide to liquidate that position. So just something I wanted to share. Doesn't obviously pertain hugely to today's report, but something if there's anyone out there wondering why the space is doing what it's doing, that might be one explanation here of why we're seeing that. Jumping into soybeans here, U.S. soybean estimates. Again, USDA decided to leave the domestic balance sheet pretty much, completely unchanged. The only change here was the opposite of corn. They did decide to cut average farm price by a dime. That's probably a retroactive move due to weaker than expected basis through the harvest lows. So I don't put a whole lot of stock in those numbers, but it is an indication anyway of what's happened and maybe what's to come. So for the most part, very flat on the U.S. soybean estimates, which was in line with what most traders were expecting coming into this one, with most of the folks expected to go to South America. Looking at South American world soybean production, the interesting thing in this report is the cut to Argentina's that maybe we expected to come out of corn came out of soybeans. So they did decide to cut Argentina's soybean production by 3 million metric tons. That was, well larger than most traders were expecting. The average trade guess was just under 51 million metric tons. So pretty much they flip-flopped what was expected. This is interesting, just given that, as of last week, it was something like 40% of the beans in Argentina were setting pods and only 6 to 10%, somewhere in there, were filling pods. So still a lot of ways to go on most of that soybean crop to get into the crucial development stages. But definitely sets the tone moving forward, where weather obviously will become vastly more and more important as we get through February and into March for finishing the soybean crop in Argentina. The weather, I should mention, does look vastly improved, and it has been improved over the last 2 weeks from the very hot and dry beginning to 2025 and end of 2024. So moving down one column, Brazil, as expected, they just left that one alone at this point. I was torn on that. I thought we might see a slight cut just to some areas got too much rain and a lot of overcast weather. I've heard is maybe trimming the top end out of that estimate. It is worth noting again that CONAB, the local domestic Brazilian agency, is slightly lower than the USDA at nearer to 166 on that number. So something to keep an eye on moving forward. But all totaled, looking at ending stocks, 4 million metric ton cut there, pretty much out of the Argentina cut, and also a slight cut to Paraguay, as you can see as well. So and China on this side was left pretty much unchanged. They're going to import the same amount of beans as thought in January. So that came out of the world less China bucket as well. Looking further into South America production, the maybe bearish twist to this report is, even though we did get higher than expected cuts in Argentinian and Brazilian production, it still stands as a record as of now at 7.93 billion bushels. As you can see, by the blue lines on there are Argentina and Brazil combined. As you can see, it's just been a steady increase since the pandemic. They've increased every year and currently at a record there. Between the two, they are now estimated to account for 52% of total world soybean production. As mentioned, I was a bit surprised by that 3 million metric ton cut to Argentina. It opens up an interesting situation here moving forward with the weather to see if conditions there have been slipping quite a bit over the last month. So there is some thought with the recent rains, maybe those will stabilize if not improve. It'll be interesting to keep an eye on that moving forward based on what the weather does in South America as always. Looking at the stocks for the world, ending stocks not including China, still the second largest on record at 78.38 million metric tons. But that is down, as mentioned, just over 4 million metric tons from the January estimate. China ending stocks were unchanged at 45.96 million metric tons. Total ending stocks still a record high if you include China, but obviously China's ending stocks are vastly, you can see the black line, since the 2019, 2020, they've really picked up the pace of stockpiling beans. So they own a huge chunk right now as estimated of world total stocks. So looking closer at U.S. demand, the soybean export pace has slowed ahead of South American production and South American beans being available for the market. As you can see by the red arrows, it's normal around March when you get the first beans headed to port in South America for the U.S. export curve to really level off. Unfortunately for this year, as you can see, we had been trending right with the 4-year average, but really towards the beginning to middle part of January, that's really leveled off about 2 months early, month and a half, 2 months early. We're seeing this leveling off. So it's not quite as dire of a situation as last year where we got 2 significant drops. You can see on the green shaded area, we had a serious slowing of pace in the late fall last year, and then another one when South American production came to the market. So a much better start to the marketing year this year for soybean exports, but we have seen that pace slow. So commitments right now running 12% above 2023, 2024, the USDA estimating an 8% increase. So not surprised that they didn't change anything there. And we'll just have to see moving forward, especially it'll be largely dependent on how the South American crops shape out. It is notable that in the balance sheets, they're not expecting any less exports by either Argentina or Brazil. Obviously, they'll need to take more out of production before we really start to eat away at their demand. So, or their demand of the world is what I mean. So, soybean crush, looking at it, on pace for another yearly record. Since 2010, there's been only 2 years where soybean crush hasn't increased year over year and set a yearly crush record. As can be seen by the red line, we're head and shoulders above the previous several years. So there is a slight maybe downward tilt throughout the year to those numbers. But December crush sent soybean crush sent 2 monthly records through the first third of the marketing year. They set a record in October and then another record in December. So through December, 830 million bushels of soybeans have been crushed. That's up 6% over year. The USDA estimate currently at 2.41 billion bushels. That's up 5.4%. So they're right in line in estimating a record amount of soybean crush for this year, largely as we know as a part of the biofuel boom that we're seeing across all markets. Looking at soybean basis, it's flattened out, slowly degraded since late fall. That's been slightly accelerated through the soybean rally since the last WASDE report. The DTN National Soybean Index implies a basis of 65 cents under the March board. As mentioned, a steady decline through January and slightly below the average for the fourth weakest in the past 10 years. So given where we are on stocks and world amount of soybeans, this basis certainly makes more sense to me than the corn basis at this point, kind of just in the middle of the pack when looking at bases over the past decade. Lastly, wheat. Not a lot new on wheat. It did, of the three major row crops covered here, it did get the only cut to the balance sheet. The USDA went ahead and cut ending stocks of wheat by 4 million bushels, excuse me, as a result of higher food usage. Sorry about that. I didn't extend my red box enough. I'm just seeing. So the cut there is right above the red box. Food usage, 4 million bushels more there, up to 970 million bushels. So pretty quiet as a result. They left exports unchanged, which I think is a semi-bullish thing, just given the mixed bag that is wheat exports right now. But overall, just kick that can down the road here. Looking to world wheat estimates, the ending stocks number, a slight decrease. As we've talked about, world ending stocks on wheat are, hard to gauge anything from. They don't seem to matter a whole lot on wheat. Wheat's as I've said in past webinars, wheat's a very self-sufficient market. It's pretty much grown where it's needed. But notably on this one, I was watching really the Russia and Black Sea area exports. The USDA did keep with their recent trend of reducing Russia export expectations for the year by 500,000 metric tons. They also did the same for Ukraine. This estimate is still trending about 2.5 or so million metric tons above some private analysts out there. So it'll be interesting to watch that. Notably, the Russia wheat export quota goes into effect at the end of this week. The middle of February through the end of the marketing year, they'll set a quota in place of 10.6 million metric tons that'll be allowed to be exported. That's drastically below last year's level, was closer to 29 million metric tons. So it'll be interesting to keep an eye on that. But also in this report, I was watching the Argentina crop finished their harvest last month. Their local agencies are closer to the 18.5 million metric tons. So the USDA is still estimating that crop as slightly less than what the Buenos Aires Grain Exchange is down in Argentina. So I expected maybe more of a boost out of there. But other than that, the most notable thing is also looking down one bucket to Australia. 32 million metric ton crop there is a very strong improvement year over year for Australia. The interesting thing on wheat is, I've circled it at the bottom, the major importers in the world are expected now, as a result of Russia not being in the market, I suppose, to import about 3 million metric tons less wheat. But notably, they didn't change anything on the demand side. In fact, they raised demand slightly for domestic feed and domestic total usage. So to me, that's a very interesting opinion, basically saying that demand's not going to change, yet they're going to import less wheat with less production as well, as you can see to the left of that box. So I don't necessarily buy that, but I think at this point, obviously, until we get into that quota system for Russia and can see who's going to step in and fill those shoes, is it going to be Australia? Is it going to be Argentina? Will the U.S. benefit at all from that? I mean, obviously, the European Union down too on exports. So someone's going to have to step in, I think, and fill that gap. So time will tell on that. This next slide just illustrates that more in a graph format. As you can see, the leading exporters, the EU and Russia, both going to take sizable drops this year in exports. Right now, you can see steady increases in Argentina, Australia, and the U.S. year over year. So as mentioned, I think those are the three probably the leading candidates to fill that gap left by Russia stepping to the sideline. It is notable that, unfortunately, the freight spreads from those other countries, Argentina and Australia, on ocean freight tend to favor them to where the most growing wheat demand is in Indonesia, for example. Just going to make a lot more sense for that wheat to be sourced out of Australia. But time will tell on that, and something definitely to keep an eye on. Looking at wheat exports running ahead of 2023, export commitments are running 8% above 2023, 2024. Shipments are 23% above last year, with the USDA estimating a 20% increase in wheat exports. As you can see, we're trending just right above the 4-year average. It's kind of an interesting thing as compared to last year. We've just shipped more wheat early. If there's an issue I see, it's that we're just at this rate not replacing sales at a very fast clip. So the U.S. exporters basically need to find some more sales to get to the USDA goal. But it is worth noting that the seasonal tendencies on wheat export sales are very weak. There's really no seasonal tendency. Wheat can be sold and bought pretty much year round in big or small volume. So there's still time, certainly, between now and the end of this marketing year to find those sales to keep the wheat export book running to where the USDA is expecting it to be. Lastly, on wheat, the wheat basis does remain historically low, with obviously a higher carryout compared to the last several years. The HR or the hard red winter wheat index implying a basis of 61 cents under the March board. It's been very, as you can see, just pretty much a straight line since fall. The green line there is the 10-year average. So you can see we're about 20 cents below the 10-year average, and the second weakest of the past 10 years. Obviously, apologize, I can't remember what year that is below, but obviously a large outlier there. So near the bottom of the cluster of the other years anyway, and pretty close to last year, just a slightly below. So in conclusion here, as mentioned, a very neutral report. I think, I've just labeled all three as neutral for now. We'll see what the price action does here for the balance of the week. But I think for corn anyway, the U.S. balance sheet being unchanged was maybe frustrating to some bulls who wanted a little bit more out of the demand. And again, the world stocks are still tight, but less than expected cuts to Argentine production, albeit they did give us more than what was expected with a 1 million metric ton cut to Brazilian production as well. Soybeans, I'm also going to go with neutral. U.S. balance sheet unchanged, larger than expected cuts to Argentinian crop, but still a very large soybean ending stock number, a record with including China, and then the second largest ever not including China. So, and then wheat, going to go neutral as well. Slightly lower than expected U.S. ending stocks, but as mentioned, the world situation March through May is still very uncertain, particularly how will the U.S. get to capitalize on Russia's absence from the world market, if at all. So that's where I'm leaving it neutral as it pertains to U.S. prices. But for now, I expect the market will largely go back to trading South American weather. That's what's going to matter here through February, particularly the planting of the safrinha crop. It'll be interesting to see the Mato Grosso Institute of Ag Economics on Friday releases their weekly planting updates. They did close that gap slightly last week, and they had a few more good days into the weekend of harvesting and planting weather. So it'll be interesting to see at what pace they've made on harvesting beans and subsequently getting the safrinha crop planted here come Friday, because the clock has certainly begun ticking on getting that corn crop in on time. So that's kind of what I will turn my attention. I think the market will turn its attention back to here and put this February WASDE in the rearview mirror. So with that is all I have for this edition of the WASDE review. We can, as always, take questions.
Yeah, Rhett, great. We do have a couple questions in. The first one is related to some of that noise that you referred to earlier. Not a surprise, but given some of the things that are going on with tariffs and some of the comments that are happening, have you noticed at all any change in the export pace of corn to Canada? Are we seeing that slow down already, or is that still sort of on pace as we wait to see what's happening there?
Yeah, so it is notable that the corn export pace to Canada and the U.S. going to Canada was already very low. Um, it's it's just not a huge factor this year. In fact, earlier uh, last week, I should say, when StatsCan released their December 31 stocks, they reported imports of grain were down over 50% year over year. Um, they blamed it on less animal feed usage, but I think it's mainly to do, the Canadian dollar relative to the U.S. dollar is also um, at a weak point historically, which isn't conducive to buying a lot of U.S. corn. So I don't think that relationship is really on the rocks, so to say, as a result of any tariff threats. It was just always, I think, going to be on the slower side, mainly due to um, uh, stocks, um, just a better domestic supply in Canada. Stocks were, slightly increased year over year, if I remember right, in that December 31 report. So they're doing that without importing much grain or much corn at this point. So they just really haven't had the need to, given where their balance sheet is currently, is how I see that.
And a related question is on the flip, and in terms of our imports of canola oil, seeing any changes there versus normal given the tariff conversation.
Not yet. It's still a very bullish situation for Canadian canola. Um, Basically, they that same report from Stats Canada basically confirmed what was already thought, that demand was just at such a strong pace through the first 5 months of their marketing year that it's getting to the point where they're going to have to ration demand on canola, both for whole canola seed exports and crush paste. So um, thus far, with the delayment of the tariffs by 1 month, I think at this point the market's, across all grain and ag commodities is basically at this point saying we're not going to price in any tariff news until we actually have something concrete to do the math on, because thus far it certainly seems like the threats are just being kind of used as a negotiating tactic on the United States side of things. Um, it seems like every Sunday, President Trump says something and the market opens lower, and by mid-morning Monday, it's recovered because at this point, it's just a lot of conjecture, I think. So until we actually have something go into place for longer than 24 hours and know what kind of retaliatory actions are put into place, then we can really start doing the math on what's it mean for the canola oil. Obviously, the U.S. accounts for the vast majority of canola oil imports or exports, I should say, from Canada. It's like 95% or something. But that being said, the situation for canola is just a supportive one anyway, just with the production decrease year over year. And there's a lot of demand for it in the world. So um, they ship a lot of the whole seeds, obviously, to China. And I think given some of the, maybe production issues on other biofuel feedstocks, such as palm oil, I think there's probably an avenue there should the relationship with the U.S. Hit a low point and those imports go down for a bit. I think there is avenues for Canada to develop relations with other countries, which is this scary part. I think from the U.S. perspective is you don't want to play hardball too much with your top trading partners, in my mind. because as we saw with China, China just, when we slapped them with the tariffs in 2018, they just basically went out and developed relationships with Brazil, dumping millions and millions of dollars in developing ports in Brazil, and they basically put themselves in a vacuum now to where if they're in a much better position, I'll put it that way, to withstand a trade war now than they were even 6-7 years ago. So that would be my word of warning, I guess, for any kind of extended trade spat with Canada is, world trade's a ever-changing thing, and it might be painful on both sides for a little bit, but different avenues can always be made to unload some of that supply, especially in this biofuel boom we're seeing. The demand for feedstock is only going to increase moving forward in my mind. So.
Great. On the bean side, you talked about how in corn, our exports, U.S. exports have kept really rapid pace and been just really top of the charts. And beans, we've leveled off a little bit. Do you think we started out too heavy, that a lot of folks were buying early on? We were shipping a lot of beans, and now the market's kind of pausing to see what happens in South America, or do you expect that pace to pick back up again?
Yeah, so I think that hits the nail on the head. I think, as you can see in that last chart, and I'll see if I can back up to it. Yeah, as you can see on this one, looking at the 4-year average, for example, we always expect it to level off and slow once Brazilian beans hit the market. It's just they produce so many anymore that it takes a lot for it not to be the world's cheapest bean when they come available. So I think with the sheer amount they're expected to produce this year, far and away a record production, I think that's exactly what we're seeing is buyers are just kind of willing to step back and wait to see how the world market shapes out, especially when you have, the far and away the world's biggest buyer is China. They have, as mentioned, a huge chunk of world stocks. Their stockpiles have, almost doubled over the past 3 to 4 years. So I think they're in a situation, of course, there's always a degree of how accurate is that number, because it's pretty much a state secret. But if the USDA is accurate on that number, then there's obviously not a huge sense of urgency to go in and pay up for a more expensive US bean when there could be a cheaper Brazilian bean coming in just 30 to 45 days. So I think that's exactly what's happening. They're just willing at this point to sit back and see how it plays out. If we get a little more of a production issue out of Brazil, which who knows at this rate, the only thing I could see that would really drive the production down would be if we get very, very late with harvesting the crop. But otherwise, I think we're going to be, again, like barring a major late issue, we're going to have a record crop out of Brazil, and that certainly isn't conducive in this day and age to a soaring U.S. export pace, just due to the new world dynamics that I mentioned in the last question, that China's relationship is really on the up and up with Brazil over the last several years.
Great. Well, thank you. Looks like that's the questions that we have for today. Just making sure. Yep, looks like those are the ones. Appreciate it, Rhett. Thanks for sharing, and thanks for the questions that came in. I want to thank everybody for joining the conference today. Again, I want to remind you that the event is recorded, and you can go to the dtn.com website and look in the events section where you sign up for webinars, and you'll find the rebroadcast in there. If you want to review this or share it with others in your operation, happy that you can do that. If you have any other questions, Rhett's email was on the last slide there, and
Yep.
feel free to reach out to us anytime. We love to get questions from you all, so appreciate that going on there. I also want to remind everybody that we are at the National Farm Machinery Show this week. will be in room 104C in the South Wing Conference area. That's the big conference part of the show with the glass on the one end. There's a number of educational rooms in there. We'll have Rhett and John Baranek, our ag meteorologist, will be giving weather and markets outlooks for the upcoming planting and summer season. And those sessions will be, all of these are Eastern Standard Time because we're Eastern Time Zone here in Louisville. 2:30 tomorrow on Wednesday we'll be there. 8:30 on Thursday morning. We do an early morning session there on Thursday that a lot of folks like just as the show is opening. And then at 10 o'clock on Friday, we'll be in room 104 again, talking about weather and markets outlooks. In addition, on Thursday at 10:30, we've got a cover crop strategies session where we're going to have some farmers and also some folks from the carbon and soil quality areas talking about cover crops, what it means to soil structure, and how that plays into carbon credit markets and some of the other things that are going on there. And some of that's being affected by some of the actions on the halt on some of the funds in some areas. So we'll have an update there, both from the farmers and from our ag policy expert, Chris Clayton, will be kind of giving a little bit of a show and tell on what he's hearing as to how the executive proclamations are changing some of the fund situations that we have going on. And again, that's at 10:30 on Thursday. Our next WASDE webinar is March the 11th. Again, at this time, you can sign up at dtn.com just as you did for today and get signed up for that. And we look forward to talking to you then. Thank you again for participating. We really enjoy doing these webinars and thankful for everybody that joined. Hope everybody's being safe. We've got several snowstorms coming through the southern, especially the southern part and Midwestern part of the area of the country this week. So be careful out there. If you're coming to Louisville, be safe and stop by and say hello. Again, thanks everybody. That concludes today's event.